Ladies and gentlemen, good day, and welcome to Firstsource Solutions Limited Q3 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankur Maheshwari from Firstsource Solutions Limited. Thank you, and over to you, sir.
Thanks, Michelle. Welcome, everyone, and thank you for joining us for the quarter ended December 31st, 2022 earnings call for Firstsource. On this call, Mr. Vipul Khanna, MD and CEO, and Dinesh Jain, CFO, will provide an overview of the company's performance, followed by Q&A. Do note that the results, fact sheet, and the presentation have been emailed to you, and you can also view this on the website www.firstsource.com. Before we begin the call, please note that some of the matters we will discuss on this call, including our business outlook, are forward-looking and as such are subject to known and unknown risks. These uncertainties and risks are included, but not limited to what we have mentioned in a prospectus filed with SEBI and subsequent annual reports that are available on our website. That said, I now turn the call over to Mr. Vipul Khanna to begin the proceedings. Thanks.
Thanks, Ankur. Good morning, good evening, everyone. Welcome, and thank you for joining us today. Let me start by saying I'm pleased to share that our revenue and operating margins for Q3 were in line with our expectations. This quarter, our revenue was nearly flat with 0.3% degrowth year-on-year in constant currency and came in at INR 15,049 million or $183 million. Organic revenue, excluding the impact of mortgages and acquisitions, grew by 18.6% year-on-year in constant currency. Operating margins have improved 100 bps over Q2 and came in at 9.4%. In Q3, we realized other income of INR 598 million due to the write-back of the variable considerations linked to performance of 2 acquisitions and a structured contract in our mortgage business. The variable payout thresholds were not met due to the adverse market conditions across the mortgage and collection businesses. And EPS grew by 17.2% year-on-year and came in at INR 2.25 for the quarter. As we come towards the end of the year, we are narrowing our guidance range. We now expect revenue growth of -2% to -1%. Excluding mortgage and acquisition, we expect growth of 12.5 to 14.5%. We expect operating margins to land in the range of 9.25 to 9.5% for this fiscal year. We are on plan to hit a normalized margin range in Q4 from the revenue growth and the net impact of our YTD year-to-date cost actions going through. I'd like to reiterate that this year has been an outlier, and the rapid changes in the broader macroeconomic environment made it difficult for us to predict accurate outcomes for our business. As we look forward to wrapping up this year and planning for the next, I continue to strongly believe that our business is very well positioned to capitalize on the growth opportunities in the medium and long term. Our strategy has been and remains sharply focused on 1, growth in our chosen verticals by building adjacent capabilities, systematic client acquisition, and by growing existing strategic accounts. 2, strategic diversification within the BFS vertical and continued growth into the select subsegments of healthcare and comms, media, and tech, with the overall goal of building a less cyclical portfolio and driving the next phase of our growth. 3, leveraging our digital tools and services to create more cost efficiency for both our clients and us with our digital-first, digital now approach. For instance, we've launched a managed services construct for automation, which is being received well by our clients. This is an all-inclusive solution from licensing to building and maintaining of automation, and all the way to making automation sustainable within an enterprise. With the global economy battling recession worries, we expect accelerated adoption of proven value levers of digital, outsourcing, and offshoring, by our client ecosystem, thereby resulting in significant growth opportunities for us. Let me give you some industry commentary. Our BFS vertical degrew minus 10.1% year-on-year and minus 14.1% in constant currency. Excluding mortgage and acquisitions, the BFS segment has grown by 30% year-on-year in constant currency. The mortgage market remains subdued along expected lines. This business segment contracted by another 20% sequentially in Q3. We continue to believe that this market has systemic strength despite the unprecedented correction this year. Housing demand is still strong, and despite the mortgage industry's focus on cost reduction, large gaps in profitability remain. In calendar 2023, the mortgage industry has the unenviable task of bringing costs down further while prioritizing the right investments for future growth. We continue to be uniquely positioned to drive this shared purpose with our clients. Our end-to-end capabilities, broad client access, and pan-US licenses across origination, servicing, title, and default enable us to customize and provide delivery locally as well as hybrid. Our sales efforts and pipeline continue to yield positive results with good closures in this quarter. Having said that, the mortgage segment contributed only about 10% of our Q3 revenue and would be between 8.5% to 9% in Q4 from a peak of 31% in Q1 of FY23. Hence, any further sharp movements in this business are unlikely to have a material impact on our overall business. In the collection segment, recovery remains on track, but the pace is still picking its way up. Overall, U.S. card debt delinquencies rose steadily to 2.08% versus 1.85% in the last quarter, and charge-offs were at 2.02% versus 1.83% last quarter. These are still lower than historical averages despite rising interest rates, high inflation, and high outstanding debt by historical standards. This is primarily due to the still very low unemployment rate and the strong housing balance sheet in the U.S. that we've seen in the past 40 years. With the U.S. economy slowing down and delinquencies expected to rise, we are seeing increased market activity and the client's need for capacity planning. Our deal pipeline for collections is at its highest and possibly the most diversified it has been across different industry segments. In this quarter, we added 7 new clients across fintech, healthcare finance, and communications. Diversifying beyond credit cards and BFS has been our focus in the last 18 to 24 months, and we are pleased with this outcome. The strong portfolio of early, late-stage, and late-stage legal collections underpinned by our market-leading digital collection platform and our strong win momentum this year all position us strongly to harness the likely volume growth over the coming quarters. While our early-stage segment has witnessed steady uptick over the last few quarters, we are now focused on strengthening the growth muscle of our legal collection segment. As we mentioned before, legal collection operates at a lag from the early-stage debt and is still finding its bottom from the lower early-stage debt through the COVID cycle. As we start to see the uptick in delinquencies and charge-offs across our client ecosystem, we are ensuring that our legal collection business is ready to capitalize on the growth momentum as and when it starts to go to the legal side of it. I had shared that reinvigorating the UK business has been a fiscal 23 priority for me, and pleased with the progress we continue to make in our UK BFS, CMT, and the diversified portfolio. UK BFS continues to deliver strong growth. With a recent meaningful win, we now have top partner status with another top 10 retail bank in the UK. The demand environment, pipeline activity, and digital adoption remain strong despite the political uncertainty and tough economic conditions. As BFS clients shift gears in cost efficiency, we see more opportunities, especially for digital and nearshore and offshore solutions. We expect this momentum to continue into the next year with sharper focus on new client adds and more offshore business activity for us. Our healthcare segment continues to grow consistently at 17.3% year-on-year and 7.2% in constant currency. The rate of growth has slowed down due to some of the deal delays that we talked about earlier. Although the sales cycles have lengthened, the deal activities remain strong. We continue to execute on a strategy to focus on top 10 health plans, grow our digital intake business, and create bespoke BPaaS solutions for the mid-market health plans. In the medium term, growth will be driven by vendor consolidation, acceleration of digital interventions across the care and plan admin value chain, and the wider adoption of BPaaS solutions. On the foundation of the pioneering BPaaS win last year, we are seeing meaningful traction. We have been selected by another top 10 Medicaid health plan for building their membership admin platform. This is our second BPaaS deal, and we will be partnering with product companies to deliver the solution. Once again, it was our domain expertise that helped us win against large integrated players. On the provider segment, there hasn't been a meaningful change in the outlook. The latest direction from the U.S. administration is that the public health emergency provision on compulsory Medicaid enrollment will end in April, and the respective state governments can take individual decisions on when and how to adopt this requirement. As the states start to roll off compulsory enrollments, we expect demand for Medicaid redetermination services to come. We continue to develop a digital solution to capitalize on this demand, and we signed up with our first anchor client for this offering. Structurally, hospitals continue to grapple with significant hikes in the medical care costs, extending the buying cycles in our core play field on RCM and other admin services. Longer term, it should lead to more outsourcing and offshoring by this industry. Our CMT business has delivered another strong quarter. This quarter, we grew 14.8% year-on-year and 17.5% in constant currency. We continue to witness steady growth from our top clients across their product and service lines with a skew towards offshoring. I'm pleased with the progress we are making in our US CMT segment and the momentum we are witnessing, particularly in the tech segment. Our US CMT segment has grown by 63.8% year-on-year in constant currency. We launched our IDEA services, which stands for Insights, Design Experience and Advisory, leveraging our deep customer service experience to address the market opportunity of designing digital CX and the pull-through to ongoing run of outsourcing. We've added 4 new clients this quarter, including 2 major tech companies. Our focus on segments such as EdTech and data integrity for machine learning are yielding strong results. A few months ago, a global education testing player engaged us for a consulting assignment to design their customer journeys and an operating model for their contact centers. That engagement has now evolved into a large-scale build and run of their CX organization with the charter of improving the CSAT and increasing their market share. This was initially an IDEA engagement. And as we plan for the next year, our UK CMT will provide a strong anchor, and the US CMT, though small, would grow disproportionately to the company's growth rate. In summary, this has been clearly a difficult year. Having said that, I'm extremely proud of the team of 22,000 plus Firstsourcers who stepped up in these dynamic times and have helped offset the unprecedented decline in the mortgage business. We've had to take some hard calls on our costs to create a more efficient operating structure. The momentum we have established in our non-mortgage businesses sets us up for strong future growth. Let me now hand over the call to Dinesh to cover details of some of our financial results. Dinesh.
Thank you, Vipul. For the financial performance for Q3 FY23, revenue for the Q3 came in at 15,049 million or $183 million. This implies a year-on-year growth of 2.8% in rupee term and flat in constant currency term. On the margin front, operating margin came in at rupees 1,409 million or 9.4% of revenue for the quarter, implying a year-on-year margin decline of 267 basis points. Profit after tax came in at rupees 1,579 million or 10.5% of the revenue for the Q3 FY23, a year-on-year margin improvement of 124 basis points. Our recent acquisition of Stonehill and ARSI did not meet the revenue targets at the end of earn-out periods, which have closed in December this year. This has resulted in other income of INR 279 million in Q3, No further contingent consideration is payable on these acquisitions. We also have a contingent payout over.
Sorry to interrupt, sir. We cannot hear you now. Mr. Dinesh Jain? Ladies and gentlemen, the line of Mr. Dinesh Jain has been disconnected. Kindly stay connected while we try to reconnect him. Ladies and gentlemen, the line of Mr. Dinesh Jain is connected. Over to you, sir.
Yeah. I think I'll start with the last item, which is our recent acquisition of Stonehill and ARSI did not meet the revenue target at the end of the earnout period. This has resulted in other income of INR 279 million in our quarter 3. No further contingent consideration is payable on these acquisitions. We also have contingent payouts to our mortgage client as part of our option purchase agreement closed last year. Basis the current visibility of the revenues against the target, the liabilities have been fair valued this quarter, and that has resulted into other income of rupees 319 million in this quarter. DSO came in at 61 days versus the 56 days last quarter. During Q3 FY23, we have generated 800 million of cash from operation, and our free cash flow was rupees 653 million after adjusting for capex of 147 million. We also have a closing cash balance, including investment, stood at 1,927 million. Due to higher DSO this quarter, operating cash flow and free cash flow are lower in Q3 and will get normalized in Q4. Net debt stands at rupees 5,891 million or $71.2 million as of December 31st, 22, versus the 6,055 million or $74.4 million as of September 30th, 2022. Tax rate for this quarter was around 14%, but we expect FY23 it should be within the range of 16 to 17%. On our forex hedging, we have coverage of pound 38 million for the next 12 months with average rate of 101.12 to the pound, and coverage of US dollar 68.5 million with average rate of 82.6 per rupee. On our forex hedging, we have coverage of GBP 15.8 million for the 12 to 24 months with average of 102.9 to the pound, and coverage of $9 million with average rate of 83.9 rupees 83.9 for a dollar. In addition to these forward, we are also taken some of the option on these forward to better our realization rates. I'm pleased to announce also that board has recommended an interim dividend of rupees 3.5 per share or 35% for the financial year. Total payable expected on account of this going to be around rupees 2,439 million. With this, I will hand over to moderator for the Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Mohit Jain from Anand Rathi. Please go ahead.
Sir, just 2 questions. First is on the mortgage business. So any thoughts there on the kind of volumes you guys are seeing, say, over the last 2 months or so? And if you could have shared some outlook for next year on the mortgage pieces specifically. And the second is on the margins. Now, margins clearly surprised this quarter. So what kind of recurring margins are you looking at? And is there any one-time cost that we should be aware of from a 4Q standpoint?
Hi, Mohit. Your voice is a little unclear, so I'll repeat your question. One was about the mortgage volume outlooks in the last 2 months and the next few months, and the second was on margins. What's the outlook, and is there any one-time cost to bake in for the
Correct.
future? Yeah?
Correct. Yes.
Okay. Okay. So I think mortgage volumes continue to be soft, right? Market volumes are low. Our clients, whatever reductions they had told us over the last several months, some of them continue to kind of act through. The interest rates, looks like the interest rates peaked and they've been coming down for the past several weeks now. And even you saw yesterday's announcement was at 25 basis points by the Fed for rate increase, which is the lowest they've done since March. So generally the market sees that this should start to bring some of the buyers back into the market, especially as we come to the spring season and schools, et cetera, start. So some volumes to come there. But from what we've seen thus far, and potentially up to the end of this quarter, we expect to see sort of weak volumes in the mortgage business. In fact, we do expect that our revenue for Q4 for mortgage will be lower than Q3. On the margin side of it, I think we made strong gains of all the cost focus and the actions we've done, and we do expect that by Q4 we'll come back to our the last year average of between 11.5% to 12% on a run rate basis, and that should be a good base for us to kind of take forward.
Sir, can you repeat the margin for 4Q? You're saying we will get back to last year average.
We think we'll come back to a run rate of between 11.5% to 12%.
Okay, and then that will be the new base for FY24.
Yep.
Okay, great, sir, and all the best.
Thank you. Thank you. We have the next question from the line of Dipesh Mehta from Emkay Global Financial Services. Please go ahead.
Thanks for the opportunity. A couple of questions. First, about the guidance. I just want to get your sense about what this guidance implies from QOQ growth perspective for Q4. Second related question is, just want to get your sense about confidence on maintaining and sustaining QOQ growth trajectory into calendar 23. If you can provide some perspective considering all the buckets of the business, how one should look QOQ growth trajectory calendar 23? Are we confident now flattish or declining phase is over for us and QOQ we should improve entering into calendar 23? Third question is about BFS. BFS segment margin is much weaker than what we used to operate in the past. Mortgage has played some role, but if you can provide, considering now mortgage weakness is largely behind, how one should look recovery in that margin? Thanks.
Okay. So Dipesh, your first question was guidance for Q4 growth. What does it imply in terms of QOQ, quarter on quarter? Yeah?
Yes.
Sorry, was it a yes?
Mr. Mehta?
Yeah. I said yes. A QOQ growth, what it implies.
Okay, sorry. Yeah. So look, based on this revised guidance that we've issued, we think this implies to 1 to 5% QOQ, quarter-on-quarter growth. We do realize it's a little bit of a broad band, but it's a quarter where we historically see some seasonality coming in from a collections business. Plus, given the continued sort of situation we have in our mortgage and somewhat in the collection business, we think this is the right number to have at this stage. And in terms of calendar 23, okay. So calendar 23, if you're talking about the future, we are kind of right in the middle of the budget cycle and kind of gathering data from the market and our teams. So something we will come back. But at this stage, given the fact that while we do expect mortgage will decline in Q4, we expect decent growth to continue in our Europe. Collections obviously will be stronger given the seasonality that we typically see from the tax season. So overall, we think we feel good about what we forecasted in terms of QOQ growth to deliver to the revised margin. On the margin for BFS, clearly, as you highlighted, mortgage has taken a heavy toll on the margins. Also the year our sort of cost lags the revenue declines. We have taken some pretty hard action across the cost structure, whether it's direct cost, overheads, facilities, etc. We also had some impact from the margins of our RC acquisition. They were lower than us when we acquired, and we had shared that. And we expected their revenue to decline. The decline has been more than we anticipated because of the macro conditions. And that has also taken pressure on the margins because theirs is a more fixed cost business. So once the volume comes back on the legal collections, we should see good gains on the margin of the collections. So these two have been heavy draggers on our margin for this year. Otherwise, the core collection business, the digital collection, and UK BFS have delivered strong growth. And some of the cost pressures that we saw in UK from labor costs and fulfillment, we seem to become kind of coming at par with them. So that gives us confidence on the margins for Q4. Does that kind of give you a color on the canvas there?
Yeah, it helps. Maybe we can get more clarity once we finish the year. Thank you.
Okay.
Thank you.
Thanks, Dipesh.
Thank you. The next question is from the line of Shraddha from Asian Market Securities. Please go ahead.
Yeah, hi. Congrats, Vipul, on a steady quarter. A couple of questions. Within mortgage, what is the current mix of origination and servicing? And do we also do the home equity bit in mortgage?
So the mix of origination to servicing is now closer to 35-65. So 35 origination, 65. So it's almost 1:2 between origination and servicing. We've seen some downward pressure on servicing as well, right, as clients have pulled back and some of the onshore to offshore sort of cannibalization has happened. Some of our clients have started the home equity line, and we are supporting in that as they start in those endeavors. Yes, we have some early start in that home equity segment.
Yeah, because one of our competitors was talking about expected, downtick that we could see in their mortgage home equity portfolio because most of the harm that had to happen in origination is already done. So are we of the same view that origination decline probably would now get stalled and we would see more of servicing decline in mortgage portfolio?
No, I would think that, sure, the refi activity has obviously come down very, very drastically. There is still some purchase activity, which was also for a couple of quarters impacted with the high interest rate. The market expects that if interest rates stabilize and kind of stay below the 5.5, between the 5 to 5.5 range, then we will start to see pick up in the home purchase market, especially in hot geographies like Florida, Texas, right? Some of those hotter markets, Colorado, etc. So over time through this calendar, we should see some of the return of the origination volume through purchase, not as much to refi. Home equity, I think, is a smaller business, right? We'll see how that plays out for the consumer. The servicing business, I think, has declined for us this year, but I don't expect any more significant decline on that from where we are. Because whatever cost actions trying to take, they've taken the first two waves of cost action. Now, in fact, some of them are looking for how do I get out of this and look for more offshoring and sort of more structural sort of solutions rather than just practical answers. So at this stage, I don't expect any significant declines in the coming year on servicing portfolio. But keep in mind, as I said, overall, the portfolio is now down to about 8 to 9% of our overall business.
Right. The other question is, this time around, we saw improvement in margins that was mainly led by SG&A coming down. But on the gross margins, it was actually still down 150 basis points sequentially. So when we say that we expect 4Q margins to revert to, the last year average quarterly run rate, so do we expect that to be led by improvement in gross margins, or do you expect further cutoff in SG&A that will help margins in next quarter as well?
Yeah. So obviously we've kept a very tight and very judicious line on our SGA, both for run SGA and for growth SGA. Our gross margins obviously continue to be impacted by one, the reduction, and two, the change in mix as well, because in mortgage, a bigger chunk of the reductions happen in the more higher margin offshore portfolio rather than as much onshore. So it's the mix of sort of location also which has played a part, and you've seen that our onshore percentage has gone up. Our onshore percentage has gone up just by deduction, right? Not that we've consciously chosen that business, it's just that offshore has reduced more. So that's kind of put pressure on the margins. As we go into Q4, I think it will help to have higher revenue. It will help to have the more profitable collection business kind of kick in. But I don't see disproportionate action between direct cost and SGA coming into the next quarter. And we're confident of hitting our 11.5% to 12% run rate for that quarter.
Right. Thanks. And just one question, if I can squeeze in. The other operating income has come off quite significantly. So is it more to do with the forex loss, or is there something else in there?
It's not a forex loss, but as the rate has moved up, that automatically your forward rates became lower. So the realization will be gone into the revenue line itself, then being other operating line. So there is no loss on a forward book, but the realization remains the same as the forwards which we talked in the last quarter.
Okay, sure. Thank you, and all the best for future quarters.
Thanks, Shraddha.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and one at this time. The next question is from the line of Prabhu Dastari from Tattva Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. I just had a couple of questions. So the first one being, do we see any challenge in recovering the receivables on the client side, considering the increase in receivables this quarter? Any stress or anything of that sort?
No, there is nothing on that front. Basically, the December quarter, due to higher holidays, we also have, our process is to take client sign-off before billing. So unbilled is also high slightly. But most of the money which is the overdue in December has been collected in Jan. Already we have collected.
Understood. And the second question being, is the other income of 309 million rupees related to SourcePoint acquisition?
That's right. That's the option agreement which we have in the past with that one of the clients.
Okay. So if that is the case, see, the expense has been recorded as an exceptional item in March 2021 quarter, but the gains currently we are showing in other income instead of exceptional items. I mean, why is there a change in representation?
No, it's two different things. I think at that time the transaction, the amount was very high and as well the exception called out. Now with the fair value accounting, all the fair value adjustment has to go through other income. So there is nothing with that sort of thing. It was an exception, so it should be exception, not that way. It's purely the way the accounting has to be done. So it has to be accounted. Fair value adjustment has to be in other income.
So we do not foresee any other gains apart from whatever we have seen, or any other losses apart from whatever we have seen.
As of today, with the fair valuation which we did, we see this is the amount going to be. It may be a small adjustment may happen in Q4, but I don't see the bigger amounts coming in. These are all the transaction flows.
Oh, that's it from me. Thanks.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Hi. On this previous query, you mentioned that you're guiding for 1 to 5%. We're already in the month of Jan. 1 month is already gone in the quarter. So you still expect such high volatility in the remaining 2 months to guide for such a large band of 1 to 5% for Q4?
Yeah, look, as I mentioned, collections is coming off a very unusual period, right? Very uncharacteristic how collections has played out in the last 18 months post all the COVID interventions which government has done and personal finances have gone through. Historically, it's high. We don't know how that will play out. So one, we are kind of watching it and keeping that range from collections. And especially now our collection portfolio is also bigger after the legal collections acquisition. So it's a much bigger share of our overall revenue than just our core collection business. Two, some of the deals that we have closed in the previous quarters, we are kind of waiting to see. We're waiting to see how the closures and implementation time pick up to see how much revenue we're able to bill to book against that. So those are the two factors which have gone into it. So yeah, Q and Q it kind of appears like that, but if you look at it, that's why we have taken the call to reduce our range and brought it to -2 to -1% for the entire year, as well as for the non-mortgage, non-acquisition range.
Sure. Second question is, when I look at your operating expense, it has reduced from 344 to 310 crores. So is it mainly because we have rationalized certain expenses as we are facing revenue pressure, and is this sustainable number? If you could give us some sense on that.
Sorry, Sachin, could you repeat what line item did you say was it?
I'm talking the operating expense that is reduced from 344 crores in Q2 to 310 crores in Q3. So is there some one-off in that, or is there some rationalization, and is it sustainable?
So I think, Sachin, the operating expense is also one of the component on our collection business, the legal collection business. So as the revenue drop, that one expense line item is lower. As well as Vipul talked about the cost actions which we taken in Q1 and Q2, that has been fructifying now. So I think some part will be sustainable, some part depends on the revenue growth, they may increase.
So of the closer to 30-35 crores reduction we have seen, sir, can you give us some sense, approximately broadly, how much was related to revenue decline and how much was related to the action that we have taken internally?
It should be around 70-30. 70% is almost with the like cost action, 30% is still linked to the revenue.
And is this one of the reasons why we are guiding for a sharp improvement in the Q4 margin from 9.5% to 11.5%?
Yeah, I think we did talk that I think all the facilities actions take 6 to 9 months. So there are cost actions which have been got effective in Q3. There are some more getting in Q4. As well as I think that we are going to a higher revenue side, automatically margin profile will improve in Q4.
Sure, but any of these actions are not which will impact our long-term growth aspirations or investments for growth?
No, these are, I think, especially the mortgage businesses have the excess capacities, and then you see the sharp downturn which have taken place. So we don't see that these are actions are going to impact any of the revenue growth side of it. It is more of a cost which was excess line which we have taken.
Sure. Just last question, sir.
Just to add to that, look,
sure.
We've taken a judicious call, kept a sharp eye on our operating expenses and our SGA. Clearly, we've had to do some trade-offs. So I'll give you an example. Our digital collection business is a growing business, right? We've seen good growth. So we continued our investment in the build of the platform on the roadmap. But since provider was soft, we took some calls to reduce the technology expense and further building that platform, right? So we had to do some trade-offs given the revenue environment that we faced. And as growth picks up, we'll kind of resurrect some of those expenses. But we've taken a call that our critical growth investments we did not compromise on.
Sure. The next question, sir, was on the net debt side. So 9 months we have seen a good reduction there. What are your thoughts going forward in FY24 and 25? You would like to reduce it further, or would you rather use the cash flows for growth or maybe higher payouts?
I think, Sachin, the working capital is the only debt which we have. We don't really have any long-term debt which we have taken. And payouts has been already seen that what we're going to pay around 243 crore as a dividend this quarter. And continue to the cash generation, if put in for a growth for sure. And what has been left out is always being adjusting to the working capital line.
Sure. Just one question for Vipul. Basis the acquisitions that we have done, what has been our experience and what are our learnings? You did mention that few of them have not performed as per expected lines. So what are our key learnings and how do we intend to improve on them when we do any further acquisitions in the future?
Yeah, no, great question. So look, both these investments were on our strategy that while mortgage and collection are cyclical businesses, we were consciously pursuing leadership in those segments, right? So legal collections extended our collections outreach from early late stage to even legal so that we can offer end-to-end for our clients. So to that extent, it did it did kind of give us a valuable capability. Likewise, the TSG acquisition extended our value chain from not just origination and servicing, but to QC and DD as well, quality control and due diligence as well, which targets the capital markets and gives access to the mid-market segment, right? That was the business case. So that core hypothesis has played out. However, the timing of those acquisitions, one could argue that once the market sort of softened significantly after that, they were also impacted, potentially more impacted than when we anticipated. And to that extent, I think the structuring of our deal worked that we did not have to pay the variable consideration. Now, obviously, it did cause more challenges to our forecasting through the year, right? And we've kind of guided you on sort of how you had to take guidance down twice earlier this year. So this has contributed to that. So I think learnings is about timing. Learning is about really thinking through the worst case in terms of the economic environment on that. And while I think the purchases are still valid, and I think they will absolutely play out in the medium to long term, at least from a forecast and how we kind of bake that into our numbers and kind of build our business plans around that, that is something that we need to kind of do much better on that. But overall, I think one of the other strategies that I've identified, I mentioned to you earlier, is besides these businesses, we now need to build a portfolio of less cyclical businesses, right? So that will be our thrust going forward. But how do we bulk up some of the capabilities in that part as well?
Great. Thank you and all the best.
Thank you.
Thank you.
Before we take the next question, a reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Thanks for the opportunity. Most of my questions have been answered, but I missed what you said about your fiscal year 24 outlook on the revenue side. So if you don't mind just repeating that and give us some guidance on that.
Sorry, your question was on the guidance for...
Yeah, for fiscal year 24.
I'm sorry to interrupt.
Sorry.
Mr. Rajesh, I would request you to use your handset to ask a question, sir. We are not able to understand what you're saying.
Is it better now?
Please proceed.
So my question, Vipul, was that what is your guidance for fiscal year 24? You made some comments earlier about that, which I missed.
Sorry. So, Rajesh, no, we haven't offered any FY24 guidance yet. We just closed the guidance for FY23. FY24, we are in the middle of the budgeting and planning cycle. So, as usual, when we come back in end April, early May for Q4 results is when we'll give guidance for next year. Directionally, I would say that the demand environment is good. Some of the businesses like mortgage, collections, and providers which face headwinds in FY23, those headwinds will ease off. So that will kind of remove some of the friction that we've seen in the growth in those businesses. While our Europe and our healthcare businesses, they continue to operate in good sort of demand environment, as well as CMT. So that should continue in good stead.
Got it. Thank you. That's all I have.
Thank you.
All right. Thank you.
There is a follow-up question from the line of Dipesh Mehta from Emkay Global Financial Services. Please go ahead.
Thanks for the follow-up opportunity. Couple of questions. Just want to get sense about healthcare business. Now, the growth trajectory seems to be softer than maybe we expected at the beginning of year. So if you can provide some sense what played out across payer and provider business. Second question is about the top client growth trajectory. It is doing well for last couple of quarters. So if you can provide some sense about the sustainability of this growth trajectory and what is driving it. Third question is about the new service which we mentioned idea. If you can give some sense about what we exactly try to do and what would be the market potential you see. And last question is on M&A. do we plan to do, let's say, M&A in near future, maybe next 3-4 quarters, or you largely believe now organic business is where the focus lies, and M&A will be maybe incrementally, but not in near future? Thanks.
All right. Let me see. So healthcare business, why softer? So look, HPHS has been on a strong growth trajectory last 2 or 3 years. This year also we've had good wins. One reason that the growth has been softer than we anticipated at the start of the year is mostly deal delays. Now that we've opened 8 of the top 10 health plans, these are very big, mature buyers. They have sophisticated buying processes. They are into their 3rd or 4th generation sort of contracts. So their evaluation process tends to be longer, and definitely longer than they themselves sort of articulate and guide in the sort of buying motions on where they'll end up. And even after decision making, because they are usually vendor consolidation or vendor switching, typically the implementation cycles are longer than if you were doing like a first gen or an organic sort of transition of sorts. So I think that's played a big role in terms of the delays in booking of the revenue. That's the one reason. Second, the thrust of our business as we get into digital intakes and DPAS, these are longer implementation cycles. The volumes kind of incrementally come to you because you're dependent on some of the technology implementations. So that's kind of the second factor that's kind of played out. Overall, I still feel very good about the healthcare business. The market is big and strong, not as much impacted by macro factors. And now we have established a good beachhead. We have a focused strategy. So I still feel good about the long-term prospects of HPHS. Provider, we play in a very narrow segment, and that segment was disproportionately impacted, especially the eligibility business was disproportionately impacted by PHE and the fact that the PHE made Medicaid enrollment compulsory, right? So if the states were to get this federal funding, they had to compulsorily enroll people in Medicaid. And you saw some of the data coming through that the Medicaid enrollment through COVID went up by something like 27%. And that was mostly automatic re-enrollment. And that impacted our volumes. And now that we finally start to see that in the coming fiscal April onwards, states in a staggered manner will take off PHE, we expect some amount of normalcy as well as demand for the Medicaid redetermination services coming up. So provider has been tepid through the years, largely impacted by PHE and the fact that we play in a narrow segment. And we are focused on broadening that capability. It's a little bit of a build cycle that we're going through. We haven't seen meaningful results yet, but something we are focused on to make sure our goal field or the play field in which we operate in provider is broader. Right? So that's the first question. Second was on our large client. Yes, we've seen a good strong year. We've grown across their product lines, their service lines. As we look into the future, I think one, the UK labor market continues to be tight and expensive. So we've seen in the last couple of quarters strong growth offshore, which is good for margins. But as we see more of that sustaining through in the future, it will have some amount of onshore revenue cannibalization, right? Because it's lower yield but higher margin. So that is one factor which will play out, I think, as we go into the next year on the large account. But overall, the fact that they are also grappling in a competitive market, in a different economic situation where people need more support in some of those payments, as they've launched new programs and new initiatives to deal with that, we played a integral part in that, which makes both of us pretty happy and sort of confident about the future of the relationship. The idea is more a very focused consulting offering that we have launched to help clients design customer experiences. Since we do so much of the digital contact centers, it's taking those operating business learning, translating into a structured design and consulting framework to take it to clients. It won't be a massive revenue, but it's kind of tip of the spear strategy, like the example that I gave of the EdTech company, where through a consulting engagement, we identified opportunities, and then we won that opportunity competitively, and that now gives us ongoing sort of outsourcing revenue. So it's kind of you've seen that strategy play out amongst most of the players, where you use that as a tip of the spear. Yeah. So a targeted consulting offering to open up, get inside the tent and then sort of win some business. Last question was M&A. So I think obviously we've taken some learnings, right? We've taken some time to consolidate these acquisitions. They've had some impact on our financials, which I think we mostly work through as we come into Q4 and go into next year. So we obviously have our defined strategy of building adjacent capabilities in healthcare, some capabilities in CMT, some capabilities in parts of the BFS business. We'll continue to absolutely evaluate both organic and inorganic sort of opportunities there. At this point, there is no conscious or a policy decision to do or not to do one of those. We'll continue to keep our stance and look for the right opportunity and build our learnings from the last two as we go forward.
Thank you very much.
Thank you.
Thanks.
As that was the last question for today, I would now like to hand the conference over to Mr. Vipul Khanna for closing remarks. Over to you, sir.
Thank you. Look, thank you everyone for your continued engagement. Really enjoy your questions and the deep understanding about our business and the insightful question that you asked. We feel good about Q3. We feel good about coming into Q4, and I look forward to coming back in April, May, and giving you an update for Q4 as well as guidance for the next year. Thank you for your time and interest. And have a great day ahead.
Thank you, everyone.
Thank you, sir. On behalf of Firstsource Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.